What's going on, everybody? Welcome back to another video here. We have a really epic one for you guys this evening. We have a lot of different economic data and events happening this week that are incredibly important to set the tone going into the September FOMC meeting, where everybody is expecting rate cuts at this current time. Now, I want to preface this video here with saying that I'm not necessarily saying that there is going to be a flash crash coming, but as a well-rounded market participant, you have to understand the different types of risks that start to build up in any given market environment, and we are starting to see these risks build up. We've been talking about these a lot. We're seeing it start to heat up, and especially with the data that we have this week and over the next few weeks here, we have to be aware of these things so that we can make more well-informed decisions. So guys, without further ado, let's get into it. And as always, if you guys wouldn't mind going down, dropping a like on this video, helps out spread this information out to as many people who actually want to learn. If you guys have any questions about what we cover in this video here, make sure you guys drop a comment and I'll get back to your questions. So the first thing that I want to talk about with you guys here is the US dollar. So right now we have Dixie on the chart. And as you guys can see, the US dollar's fallen off a cliff over the past couple of weeks here. Dixie's calculated it's compared to a basket of about 6 other different global currencies, and versus those currencies, the dollar has gotten a lot weaker over the last few weeks here and is making its way down to 100, which is this first dotted line right here. That's the alert that I have on it. Now, what have we talked a lot about with the United States dollar and how it affects the global market right now? Well, we could go through Triffin's dilemma, debasement of currency, all of those things. But the most pertinent issue that we have right now, and we'll probably do webinars on things like that in the Discord once it's released to all of you guys this Sunday. But the most pressing issue is this situation with the Japanese yen and the carry trade. Remember, we're going to talk about this carry trade situation a lot until it really starts to balance out, because again, you cannot have one of these quote unquote free money trades that people were wildly over leveraging into. You start to see the unwinding of that. And then you see a bank like JP Morgan come out and say that 75% of all of these carry trade positions have been unwound, but you didn't see any of these big funds blow up on this giant move down. And you didn't really see a broad market reaction, and it would be very hard to unwind that multi-trillion-dollar position in a matter of days. So what are we looking at here? Well, we've been talking about a lot that the fact that these rate cut expectations are going up are sending the US dollar down. What we've seen a lot over the last couple of years here is the Fed giving more guidance than it should. Stanley Druckenmiller had a really interesting comment about this a couple of months ago, where he effectively was looking at Jerome Powell being on the cover of some magazine and was like, he's not some sort of celebrity. He's the FOMC chairman. He should be dictating policy, issuing those decisions, and really not a whole lot else. The fact that the Fed is continuously coming out and saying a lot of things about the overall economy and markets is causing a lot of investors to start moving money around, because the Fed is giving this type of guidance, and it's led to a lot more volatility in bond markets. You can see, we've talked about this a lot, the pendulum swinging back and forth on rate cut expectations. Going into the year, we were expecting like 6 to 8 rate cuts. Once we started to see a little bit of hotter data than expected, those expectations went from 6 to 8 rate cuts all the way down to 0 and some hikes. And then the data started to look a little bit better, and we saw that pendulum swing back and balance out. We recently saw that happen, where we saw it was mainly during this Japan situation here, where we saw these Wharton professors coming out and begging for 75 basis point rate cuts. We saw recession fears and things like that. And that was when we also saw bond yields starting to go through the floor, as you guys can see right in here. So we have this pendulum swinging back and forth. Now, again, for those of you guys that still don't necessarily understand why this move down in the dollar and the potential move down in USD JPY over here can cause somewhat of a flash crash is that when this carry trade is put on, well, they have to do something with those assets. If you're going to go out and get a loan from, let's say, Japan for really, really low, let's just say for the purposes of this example, 1%, and you can go to the United States and let's say get a risk-free rate of about 5%. Well, you have a 4% spread there, but you have to remember that the currencies that you're converting back and forth between, well, the values and the exchange rates are going to change. So if we continue to see the yen strengthen versus the dollar, it eats into that margin of those trades. Now, what a lot of these funds were doing was taking out these loans and coming and buying US assets. So if those assets aren't going to wildly outperform any movement in the currency market here, then obviously those funds are going to have issues. So that's why we've been talking a lot about Japan here, the dollar, bond yields, and things like that, because if this continues to move down through this recent low in USD JPY, we easily could see out of nowhere, and this is why I talk about it in terms of a flash crash, because those are only possible when nobody is really expecting them. It catches everybody off guard. So if we start to see USD JPY fall through, the repatriation starts to happen again, they sell US assets to go pay off these loans that they have out in Japan. Now, why are we talking about this today? I mean, some of you guys might be at this point in the video saying, well, we've talked about this a lot. The reason is that tomorrow at 8:30 a.m., we are going to be getting our second GDP revision. The initial number came out at 2.8%. First quarter was very low, sub 1.5%. I think it went from 1.8, 1.6, 1.4. These revisions were not good for the first quarter. We came out a little stronger in the second quarter here with about 2.8%. And that's what the expectation is. So they're not really expecting a revision right now. The median forecast for this revision, 2.8%. Now, here's why this is important. When we come over here and take a look at the, or this is a little bit different. We'll talk about that in a second. When we look at the summary of economic projections from the Fed here, the year-long GDP rate that they're expecting is about 2.1%. With what we've seen right now with Q1 and Q2, and when we come back over here, what we're expecting for Q3, well, it puts us right around that 2% target for 2024 here. Now, what happens if GDP comes in lower? Well, slower growth is going to then spark some more recession fears. Again, the technical definition of a recession is 2 declining quarters of GDP consecutively. We haven't gotten there yet. We haven't even seen one. But the market is kind of acting with all of the other data points, inflation coming down, unemployment going up, and the revisions that we've seen in the labor market, that there are some recessionary pressures looming over the market, which is why when we come over here and we've been talking a lot about these rate cut expectations going into the end of the year, that we've seen it really hovering between this 100 and 125 basis points by the end of the year, meaning that at one of the next 3 Fed meetings that we have throughout the end of the year, that one of them would be a 50 basis point cut. Now, tying that back into that GDP number that we were just talking about, if the GDP revision comes in a lot lower, what would we expect to see? Dollar falling lower, USD JPY falling lower, bond yields falling lower, as well as investors start to price in more cuts sooner. The other thing that happened today that is interesting, that is giving us these signs as well, is the 2-year Treasury auction. Now, we're not going to go into that as much in this video, but what I will tell you about that auction is that there was a lot of demand for those 2-year bonds. What that means is that investors are trying to lock in higher rates now and are foregoing the opportunity to wait to purchase those bonds later because they think that rates are going to be a lot lower in that 2-year time frame. So they're pricing in basically a lot more cuts than maybe the market actually needs. Now, what does this actually mean for the market in the short term? Well, honestly, we're going to have to wait and see. We do have Nvidia's earnings tomorrow, and in the short run, I would not expect any crazy GDP data to come out and really influence markets unless it's wildly off the expectations that we have. And the other thing that we've started to see, I know for a lot of this year, we've seen quote unquote bad news as good news, meaning that when unemployment would come out as a little high, inflation would come out as relatively low, GDP would come out as relatively low. Those are typically, in a normal market environment, bad things. And the market would start to move up on that as rate cut expectations were moving up. But what most people are looking at here and what they're thinking is, well, I think rate cuts are bullish. And that's not necessarily the case. If you look historically at rate cuts, after the first cut, the performance of the indexes, the S&P 500, is typically negative. In this case, I am of the opinion that this market and everything is a completely different situation, but you can still have that sell-off, just not due to the typical reasons that you would typically, like historically see as why the market would be selling off. And an example of that would be typically when the Fed is going to be cutting interest rates. It means that the economy is not in a good spot. We're in a recession, super high unemployment, inflation's coming really, really, really low. And that's not necessarily what we're seeing right now. Yes, we are seeing slightly lower growth, or like Powell likes to call it, below trend growth. Unemployment is ticking up, but inflation still isn't at that 2% target from the Fed. So are we in that dire recessionary environment? Not necessarily. So the signal from the Fed of cuts wouldn't really do anything to the market coming to the downside, because again, like we were talking about earlier in the video, the Fed has already telegraphed their move and essentially shown their cards to the market of almost exactly what they are about to do. We don't know the amount of cuts, but we do know that we should expect a rate cut in September. So to kind of wrap this up in a little bow here, remember, if the dollar continues to sell off and the yen continues to strengthen against it, and we see this move down here, and the reason why that could happen is some of this GDP data, and also we have PCE data coming out on Friday as well. This is the Fed's preferred metric of inflation, and that can absolutely influence the dollar, bond yields, and USD JPY as well. So we're going to have an interesting week, team. There's a lot of interesting things happening. There are a lot of amazing setups that are forming. The market is going to be a little choppy, I think, until NVIDIA earnings and PCE, but there is a lot of good opportunity out there. So guys, that's going to wrap up this one. If you guys did enjoy the information and analysis that I provided you guys in this video here, make sure you guys drop a like down below. And if you have any questions about what we covered here, drop a comment. I'm more than happy to answer any of your guys' questions. Other than that, I'll see you guys in the next one. Peace.